talking with Julia Karoly, from JP Morgan's Fund Finance team, and Guy Miller, Audit Partner in Financial Services here at Withum. Julia and Guy, thank you both for joining us today.
Thanks for having me, Colleen.
Thanks, Colleen.
Okay, so we're going to cover some of what we're seeing in terms of fund finance in the market. So let's get started. Julia, what are you seeing in the fund finance market today, and how does it compare to where the market was about a year ago?
I think a lot has changed, obviously, in 2023. I perhaps have a biased view, which could be good or bad, in that I came from First Republic Bank, so sort of witnessed the very quick collapse of SVB, and then a slower burn but quick collapse of First Republic. A lot of liquidity was in the system, via stimulus and other things. And I think that was a very competitive period for lenders and, lenders competing for business. But obviously, as we saw with the rapid interest rate hikes past year, the collapse of the banks, the pendulum swung back pretty quickly when the Fed, started to raise interest rates to deal with inflation. So yes, I am biased. I'm now with JP Morgan, following the acquisition of First Republic. Certainly rates are up and credits, contracts a little bit.
So it really went from a borrower's market more so to the lenders at this point.
So.
Yeah. So Guy, can you tell us a little bit about what you're seeing clients doing in the current market?
Sure, Colleen. So I think in the venture capital space, we're seeing a lot of fund managers really acquire positions, ahead of their launch, right? Using some of their own personal capital, as well as any financing they may obtain either through the GP entity or the management company. Typically, they'll then warehouse those investments while they look to raise capital, bring in more commitments, get to a decent number of commitments, and then make those capital calls, and then they'll repay the monies back to the GP and the management company with the monies from the investors, and sell those investments to the fund. I think on the private equity side, we're seeing some of the funds use leverage there, also to finance capital calls and just to kind of improve their returns in general. Those lines will be collateralized by the assets of the fund and the uncommitted capital that hasn't been called yet, and then it gives the fund managers quicker access to the monies, and it also cuts down on the burden of making numerous capital calls within a year, and going out and bothering investors, right, to really make a lot of contributions to the fund.
Yeah, so it helps operationally, I guess, as well, to be quick and able to jump on an investment when they see them.
Yeah, I think you don't want to constantly be committing and paying monies into these funds.
So Julia, how has the rise in interest rates impact the market and the volume that you see?
Yeah, it's interesting because it relates to what Guy was speaking to, in that, I would say, a few years ago in the very low interest rate environment, borrowers were really pushing these capital call lines for IRR enhancement and keeping their draws out long. But hey, interest rates were really low. And I think we're kind of going back to the fundamentals of the capital call line, which is, to make it operationally more efficient, perhaps to call capital quarterly. If they make 2 investments in a month, that's kind of annoying to, burdensome to go to their LPs. I think we're kind of, given the interest rate environment, I think the demand is definitely still there. Borrowers, are accepting the higher pricing, but perhaps keeping draws out less. So kind of returning to the original model of what these products were intended to do is bridge capital calls and make it operationally, more efficient. So that's interesting, what you said, Guy. So yeah, I mean, of course, rising interest rate, as I spoke to before has led to a decrease in volume. I mean, you have a couple banks, vanishing and interest rates going up, and banks being, I would say, more selective about how they strategically deploy their capital. Capital is not unlimited. And so I would say the general trend is that lenders are being more selective with the sponsors that they have relationships with, and maybe a greater holistic relationship with additional business across different lines of business across the bank. I think that's important to a lot of lenders now. I would say as a borrower, it's good to get ahead of these things early and talk to your lender or lenders, and start the conversations early, to see what they could do. Economics are important, to us in the rising interest rate environment and with all the uncertainties out there. At the same time, the volume of loans is decreasing, but we also are seeing new players enter the market, which I think is healthy, for competition. And I think we need banks of all sizes, to suit different kinds of clients.
Great. Well, thank you both for joining us today with the valuable insights that you have, and stay tuned for our next episode of The Alternative Route.
Thanks so much, Colleen, for having me.
Thank you, Colleen.